funny. I just did my weekly perspective. I did it on Saturday this weekend. Which exact word you said. Usually on a really strong market, you get a 3x on the stocks versus the bullion. But right now we're at a 2x, and that's what I said. Also, there's a case to be made by mostly the bullion dealers. Well, don't buy the mining stocks. They underperform the bullion. Well, that's not true because that's based on the HUI and the XAU. So the miners are outperforming. And I think there's reasons to own the miners as well. And that is people that are worried about confiscation. If you have mining shares, those aren't going to be confiscated. I call it a high level consolidation, high level because we had such a drastic move up, and it's making a channel formation. So if you go from that top peak and discard that, and you go to the second littler peak and kind of discard that, and you go from right under that peak and just draw a line on the top of those tops and the bottom of those bottoms, that's called a channel formation. And a channel formation is one of the easiest ones to trade. If it breaks up through the channel formation, you go long. And if it breaks down through the bottom of the channel formation, you short. And that's how you trade that type of a formation. Again, very simple. I use what I call the Morgan rule, which is it breaks through the horizontal channel. It's got to do it 3 days in a row, and it's got to be above average volume. Low volume doesn't tell you much. Big volume does. So I'm happy that's going sideways because it's building another base at a high level, around the 4,000 level, and more people are basically even. In other words, the bulls aren't winning and the bears aren't winning. They're kind of neutral, staying in a very small area between a couple hundred, $300, move up and down. So they're basically evenly matched. At some point, they won't be evenly matched. The bulls will win or the bears will win. I suspect the bulls will win and will move up from that channel formation, probably up to a new high. Not immediately. I mean, all markets move up and down, but we'll probably be looking toward the $5,000 level sometime in 2026. I doubt it. I mean, very difficult to say. I mean, does it look like a double top? Yes, it does. Is it a double top? Maybe. I don't think so. Basis gold, what we just showed. So if you look, you can go back to gold. I wouldn't, but it's up to you. The peak in gold on the left side was much higher than the peak on gold on the right side. But in silver, they're matched. So they almost are identical.
Yeah,
so gold is actually telling us ahead of time that it needs to consolidate. It needs to take a breather. While silver was ready to challenge the all-time nominal high one more time, and it failed. But that doesn't mean it's not going to consolidate like gold, which I believe it will. And silver is starting to outperform gold on the gold-silver ratio. I mean, it wasn't that long ago we were over 100. Now we're in the 80s, which is not historically is still very high for the gold-silver ratio, meaning silver's really not caught up and outperformed gold as much as I think it will in the future, but it's doing its job, and it will, I think, continue to perform or outperform gold over the next series of months and years. I really am kind of a lone cowboy in the thought process that we have a 2-year market, 3 maybe at the most. Many think we've got a 10-year bull market, and on fundamentals, I would agree with that. The reason I am one of the lone wolves that we only have a few years is because I'm pretty well convinced that we are going to see a new monetary system in short order. And that when that takes place, I think all bets are off. We don't know what gold and silver are going to do, especially if gold becomes part of the new monetary central bank digital currency or something along those lines, where we have a new system based on basically a cashless society with social credit scores and a bank account that you have to opt into.
Yeah. So you're saying that silver could top out within a few years. Is that correct?
Yeah, no, and again, I reserve the right to be wrong. I mean, I've certainly not made perfect calls, but I'll put my record against anyone, especially calling the tops. I've got them all so far, the major tops. But the acceleration phase is the greed, panic, FOMO. And you get those big accelerations like you saw in 1980 and 2011. We're going to see that again. And I think, again, it could be as close as a year and a half away. And you see silver go from $60 in November and $120 in February the next year. So in a 4-month time frame, it like doubles or something. You get those kind of moves, you got to be really careful about getting out. But we're not there yet. Now, if we're in a 10-year bull market, and I can't rule it out, I don't know the future, it would be more of a steady eddy kind of build and base, build and base, build and base, and the fundamentals get put into the price action. But I don't think we have that kind of a market. We've got a very emotional market. We got a very fear-driven market that's going to increase in fear because of non-trust of government currencies worldwide and untrust of the political class, generally speaking, the war efforts, and what's going on basically in the budget deficit that everyone is now acknowledging in the financial arena in the public way, where basically we've seen Moody's downgrade the U.S. Treasury market from AA, little a. In other words, they've downgraded it slightly. And anyone that knows anything about math knows that this federal deficit cannot be unwound. The only way to really do it is by a reset of some type. And there are several ideas about how that might occur.
Gold and silver often move together, but their behavior today paints two different stories. Gold's recent peaks hint at a need for consolidation, while silver has pressed harder against historic highs, reflecting growing investor appetite. The gold-silver ratio, previously above 100, has slipped into the 80s, still high by historical standards, yet signaling silver's gradual outperformance. Analysts expect this shift to continue as silver responds more dramatically to monetary pressure and supply constraints. These moves highlight an important reality. Markets rarely advance in perfect harmony, and divergence often plants the early seeds of the next major trend.
Long-term historical view of silver here right in front of us. And you can't see it here on this chart in particular, but we did form this cup and handle pattern stretching all the way back to 1980. And I mean, wouldn't that imply that the move in silver would be a lot more extended out than a few years? I'm sorry, I'm harping, I'm being kind of sticky when it comes to that point, but I'm just really trying to understand.
Sure.
Like,
No,
I
love it. I mean, I like being pushed back. I mean, I'm not an objectivist like Ayn Rand, but I certainly adhere to some of her philosophy. And one of it is check your premises. Before you throw a rock at somebody, make sure you're on solid ground, and maybe something changed in your data set or your knowledge or your belief or whatever. I'm basing it on basically, being a student of the markets pretty much from the time I was a 16-year-old kid. That's a bit of a lie, but that's when I started trading stocks. I was that young, and I really got serious about it in my 20s. So, I got like 50 years if you want to add it up. But the point is that if you believe in more or less the Elliott wave theory, and I'm not an Elliott wave guy, but there's 5 waves. There's 3 up and 2 down. So you got a wave up, and then a correction wave, another wave up, and a correction wave. And then the last wave, the 5th wave, is the maximum in price appreciation and the minimum in time duration. And that's where that adage that I got really from Jeff Christian of the CPM group, that 90% of the move comes in the last 10% of the time. That's the FOMO, fear, panic phase. And it's not just the metals. And that's what gives me more solidity to push and build my case. It happened in the stock market during the tech wreck of 2000, happened in the housing market in 2008 and 9. It's happened in commodities across the board. And so I expect it to exhibit what I would call standard market behavior, that markets accelerate at the end. And you can actually project what it's going to do. If you take the third wave up, as after the crash, it went down to 9 and up to 45. So it was a 5X. Usually the last leg up, the one we're talking about, and how long is it going to last, is double that. So if it was a 5x, you do a 10x. Well, what was the bottom of the last wave? And that was during the illness scare in March of 2020, and it hit about 12. So if you multiply that by 10, you get $120 silver. Do those numbers work out perfectly? No, don't hold me to them, but a general idea. So I'm sticking to it, Danny, until proven otherwise. And I'm very good at eating a bit of crow if I need to, but I'd rather be prepared for, let's say, my own thinking rather than going along with the herd and saying, oh, the consensus is this and therefore it's that. I'm not going to do that. I never have, and I probably never will.
Some analysts believe the current metals bull market may last a decade, driven by economic strain and weakening faith in global currencies. But others suspect a shorter, more explosive cycle. Their reasoning focuses on the possibility of a major monetary restructuring, potentially involving central bank digital currencies and partial gold backing. If such a transition arrives, price behavior could become unpredictable as old financial systems phase out. In this scenario, gold and silver may surge quickly, peak abruptly, and then reprice under new rules. This belief has created a sense of urgency among investors anticipating dramatic change.
Danny, if I could just add to that a little bit, there are seasonalities to the commodities. They don't hold 100% of the time, but there's seasons where you want to trade wheat long or short. There's seasons where the cattle market does certain things. Again, it's not a given, but it is a help. And the seasonality for the metals, especially the other white meat, I'm trying to be funny here, platinum, palladium, you can almost always make money trading on the long side for the PGMs. I don't know why. I think perhaps the manufacturers buy in January just as a matter of habit. I don't know. But the feed for gold and silver historically has been strong in the January, February. So that would suggest that the bull case is more likely than the bear case you just showed.
Interesting. Yeah, we've got seasonality here. This is the blue line is the 5-year seasonality, and the red line is the price action today. So we're in late November. Typically, we are not, we've moved up significantly higher than we have in the last 5 years on average, which makes sense. I mean, this is a breakout that we're seeing, but we are significantly higher. We can also look at, let's look at 30-year seasonality. We're also above that. We can look at every type of seasonality out there, 30, 50, 15, 10, 7, last year, this year, 3 years ago. And in each case, we are above that. So, one can say maybe we are a little overstretched and we need to calm down, but it's really a confluence of evidence that we have to look at here, Dave. One piece of evidence is not enough to make a conclusion, but rather it's the overall picture.
Couldn't have said it better, but I also push back on you a bit. I don't push back.
Sure.
It also could be indicating what I said, that we're in that acceleration phase.
Yeah, that's true.
It's not going to last long. Look at how far above the average it is. Like, wait a minute. Well, Mr. Morgan's correct that we're in the 90% of the movement comes in the last 10% of the time. Get ready to pull the trigger. I don't want to sell my metal for fiat, but if I could sell it for a house, it's dropped 50% because the commercial real estate market is in a horrible state in 2026. And silver peaks at, say, the 120 I just indicated. I got to take a look at all of this stuff, and it's very difficult. The hardest thing for me is to try to get close to a top for, our members. And, obviously I'm going to do my best to do that. Anyway, I'm not saying you're right and I'm wrong. You know me very well, but it also could be looked at it from a different perspective.
Right.
Well, it is way out of whack with the historic standard. But if we are in that last phase, it could, not would, explain it.
Throughout history, markets often reserve their most extreme gains for the final moments of a bull cycle. This acceleration phase is fueled by fear, speculation, and the widespread desire not to miss out. Silver's past behavior illustrates this perfectly, doubling within months during previous surges. Analysts applying pattern theory estimate that if silver follows historical tendencies, it could experience a dramatic final wave that moves faster and farther than expected. Yet such phases are short-lived, and timing becomes difficult. Investors must balance excitement with caution, understanding that emotional markets can reward and punish with extraordinary speed.
No, I mean, that's a very good point. The fact that this red line is significantly head and shoulders above everything else, I mean, that could be a telltale sign there's something weird going on, that this is something novel that we're witnessing right here, like you're pointing out. And on top of that, if you look at all these other lines, they seem to start moving up, starting in January all the way up until the end of spring or so, or April or so.
Those are the older ones. Those are more historic. Like I said, I got 50 years experience does pay if you keep trying to get better and better. And if you go down to the earlier ones, they don't work out as well because we have had the last day of trading as the lowest print in gold several times during this last bull market, and that was like very counterintuitive to what historically takes place on a seasonality. So the black line, the big one, the digestion of many years, is the most accurate for my lifetime. That's what I've witnessed over all those years. But if you go again, shorter duration, it's kind of like flat if you look at the bottom one. Anyway, I'm just trying to make good judgments with these tools. I don't overuse them. They have their place, but you got to use your own brain as well.
Commodities often move according to seasonal patterns, and precious metals are no exception. Historically, gold and silver strengthen in January and February as investment flows increase. Current prices already sit well above multi-year seasonal averages, hinting at either overextension or early signs of a powerful new phase. Meanwhile, mining stocks, often criticized for underperformance, have begun outpacing the metals themselves. Their leverage and resistance to confiscation fears provide strategic value, especially for younger investors seeking higher upside. Together, seasonality and mining activity form subtle signals. Markets are shifting, and the momentum beneath the surface is growing harder to ignore.
It's funny, I just did my weekly perspective. I did it on Saturday this weekend. Which exact word you said. Usually on a really strong market, you get a 3x on the stocks versus the bullion. But right now we're at a 2x, and that's what I said. Also, there's a case to be made by mostly the bullion dealers. Well, don't buy the mining stocks. They underperform the bullion. Well, that's not true because that's based on the HUI and the XAU. So the miners are outperforming. And I think there's reasons to own the miners as well. And that is the people that are worried about confiscation. If you have mining shares, those aren't going to be confiscated. The other thing is you do get leverage, and also you have, the ability to write options on them, which is a nice income source backed by gold, which many people don't know about or don't teach, which I do. So I think it's good to have a balance. And in the How to Use the Morgan Report, when you become a premium member, I outline guidance. And guidance is the older you are, the more you should probably favor physical over the equities. The younger you are, the more you can take the risk of the equity side. But I think a balanced portfolio actually has them both. And you can get some real winners, especially in the junior sector. I mean, you look at someone that specializes in that arena like Don Durrett. I mean, there's you can really bang them out if in the right market. And when you get a really strong bull market, you're going to see anything with gold and silver in its name move up. We're not there yet in my analysis, but we will probably get to that point in the, I think, not too distant future.
Yeah, well, have you heard the news? I mean, Tucker Carlson is starting his own gold bullion company. So you've got some pretty big names getting in on the action.
You'll see more and more of it. I mean, at the end of the age of empire, and when the big empire starts to fail more and more, which the United States is, and what I like to call the Anglo-American empire, because it's really the Brits and the Americans, with London being really the financial center more so than New York, believe it or not. And that Anglo-American empire it's winding down. China is the new financial empire. You see what's going on with the amount of gold that China's imported. You use the adage that's corny but true: he who owns the gold makes the rules. China owns most of the gold, they're making the rules. You're seeing, well, what have they done? They've done a beta test for the world on a new monetary system. They already have a phone system that you use with WeChat or Tencent, and everything that you do in the 400 million in the cities, you can't use cash. Everything's done by the phone. Well, that's the world system that's been done in China for a few years. and it's based on a social credit score and how well you obey the rules that are come from on high, and that's what we're pushed into. That's the idea that the banking elite want. These are internationalists. They have no propensity to be aligned with any given philosophy politically. All they think about is money and control. And so it's right in front of our eyes if you take a look. Then, if you've noticed, you probably have, and we're a little in the weeds, but I hope we can stay here a bit, that some of these sites that were taken down are now lifted and they're back on X and YouTube. And there's a reason for that. So some of these more, let's call them quote unquote conspiratorial websites, for lack of a better term, are allowed to come back. And why is that? And the big why, and this is intent, do I know for sure? No, but my highly intuitive self says they want that data because they want to know how far we're going to push back on this new system and what our vulnerabilities are. So there may be one for, well, let's, I won't go too far into the weeds, but they want that data because that gives them an advantage, or at least enough data to, find out who's who in the zoo, who we don't like, and who's going to have, something given to them that they have, like an ultimatum, perhaps, that you either get re-educated by the re-education camp, or you lose your sight, or you fill in the blank. I don't want to be too negative here, but look, this AI thing is like most technology. There's good and there's bad. And how is it going to be used? How is it going to be implemented? Certainly, it can be used for a lot of really, really good. Conversely, when everybody's spied on 24/7, and then you're monitored with that level, and there are edicts that are not free market, that it's determined how many calories you can burn, how far you can drive, when you can fly, what size apartment you can have, what type of education you get, whether it's public or private. And all that's determined by, let's say, a credit score, carbon footprint, or a social credit. You are in a dystopian nightmare under the most unbelievable Orwellian system. I mean, when George Orwell wrote 1984, it was a dystopian future that was very bleak. And yet, what I see is more of a Brave New World, Aldous Huxley's type of vision, where we are so glued to our black screen and so entertained that we don't even notice the real world around us.
As global systems evolve, so does the infrastructure that governs money, movement, and personal data. Nations experimenting with cashless frameworks, social credit scoring, and digitally controlled banking hint at a future where economic behavior is closely monitored. China's widespread digital payment networks demonstrate how quickly such systems can mature. Critics warn that AI-driven oversight could transform convenience into control, limiting personal freedoms in exchange for seamless transactions. Whether or not this future arrives, investors increasingly view precious metals as a hedge not just against inflation, but against centralized power. In uncertain times, assets outside digital reach become invaluable.